Hello and welcome. And we're here at Holistic Investments, and I'm excited to have here another amazing guest, Joe Flanagan, who's a co-founder and executive chairman of Maple Finance. Hi, Joe.
Hi, Constantine. Great to be here.
Really good to have you here. I know we planned it for quite a while, and we're going to discuss incredible things regarding Maple Finance, the future of DeFi, and also we can talk a little bit about our partnership. But before that, traditionally, I'm starting with a legal disclaimer that this content is for informational purposes only, and you should not construe any such information or other material as legal, tax, investment, financial, or any other advice. Now we can talk DeFi. So, Joe, I know like Maple Finance is incredible success. We can tell it openly. Like you have more than 600 million in TVL. You have incredible institutional partners. It's one of the top lending and borrowing protocols in the industry. When I try to look up your history, right, what did you do before? It's like an enigma, right? So so the first natural question for you is how did you even get to crypto? Because there's a interesting jump towards becoming one of the biggest protocols and you working in very different industry before.
Yeah, absolutely. So my background is in accounting and finance. So I first came to college in America, and I was on tennis scholarship here, and so I kind of always had that expansive mindset leaving Australia. And I got into accounting and finance, and then eventually I joined a commercial fintech startup. And we were doing commercial lending and really growing. We went from 10 to over 100 employees. We went from being, and then we registered on the Australian Stock Exchange, and I grew a lot personally. So I then became the youngest CFO of a publicly listed company in Australia. And then importantly, that is where my co-founder and I met. And so he joined that business as well, and we were running the finance team together. And as part of our expansion, we were launching securitizations and structured debt. And we saw how broken that process was firsthand. And we weren't in crypto at all. Maybe we held a little bit of Bitcoin, but we didn't know anything about crypto. And this is before, we're talking 2017, 2018, before the term DeFi even existed. And what we started searching for was a way that we can bring some automation, some technology to institutional debt issuance. And that's really where the idea first came for Maple.
Beautiful. I mean, and that was in 2020, roughly.
So we actually started with the first 18 months, we were funding everything ourselves, and neither of us are technical. And so we were building little proofs of concept and just kind of learning and exploring within the space. And the one of the first proofs of concept, and this was in kind of middle to end of 2019, was a proof of concept on top of Compound. And if you remember, Compound was like one of the original DeFi protocols, but this was still when Compound only had $25 million in it, like before DeFi existed. And we built a structured debt facility on top of Compound earning tokens. So you had senior and junior notes that sat on top of Compound earning tokens. And that's why we're actually called Maple, because a debt stack like that with senior, junior, mezzanine notes looks like a stack of pancakes, and the cash flows go down like maple syrup over pancakes. And so that was the original proof of concept, and really the aha moment for us where we're like, okay, there's no assets that exist on chain, right? Like there's nothing here that's actually worth securitizing. And so that's where we decided, okay, we need to go and be the actual issuer of those assets. And that's what Maple is today. At its core underlying infrastructure is that it is the originator and issuer of institutional debt. And so that was really our moment to now be able to say 6, 7 years later that we've now issued 7 billion in loans through the platform.
Yeah, and this is impressive. So, I after a partnership, I talked a lot with different traditional folks to kind of showcase this. And as you can imagine, people who've never they never played with Compound or Aave or many other traditional protocols in our space, right? They're skeptical by design. So maybe for those folks, like you can help us to understand what actual problems are you solving that none of the current other, like, lending and borrowing traditional protocols are able to solve with DeFi?
Yeah, as compared with some of the other lenders within the DeFi ecosystem, our focus is on institutional debt, and that is facing off against institutional counterparties. And what we're really focused on is two things. One is providing a product to those institutions that meets their requirements, meets their understanding of how debt products should operate, meets their customer service requirements, meets their structuring requirements, but then is making that much more transparently available. If you think about private credit or institutional debt as an extremely opaque marketplace, no one really knows what's going on underneath the seams. Everyone is used to month-end reporting that's provided 30 days at best later than that month end. And so what we've been able to do is combine the best parts of unique structuring and facing off against institutional counterparties with all of the benefits that DeFi and blockchain technology can enable. And so that's kind of our unique twist and unique focus, is that you're getting exposure to the largest institutions within the crypto ecosystem. These are all over collateralized secured loans, so backed by liquid digital assets. And then it's being kind of wrapped and managed by Maple as an asset manager to provide this unique end product that you're able to allocate your capital into.
And then you mentioned about the requirements, right? So some of the requirements that a retail person would never even know, right? Maybe can you enumerate them, some of them that are pretty unique for institutional grade product?
So some of the things that institutions require, then there's quite a long list, but let's take a few examples. Is that one, they don't want to be wrapping their collateral, right? So they've got Bitcoin and they want to borrow against that Bitcoin. They don't want to be like wrapping that into an Ethereum wrapper and then putting it into a smart contract. They want to be leaving it at their qualified custodian of choice, right? So they know that they're not taking principal risk on that Bitcoin, but they want to access leverage against it. So we're integrated into the custodians. So we're meeting the customer where they are, where they want to keep their Bitcoin, and then providing leverage against that through our smart contract infrastructure. Another is that they don't want automated liquidations, right? So they don't want to be subject to a spike in prices or a big candle down, and then all of a sudden they get an automated liquidation trigger, right? So then now with us, they get a margin call warning, and so they have a period of time in which they can top up their collateral requirements. Another big one is then compliance requirements, right? These guys are concerned about their AML responsibilities. And so that's where we're able to provide, where they're facing off against us. They're able to KYC Maple entities. We're also KYCing and understanding them. And then for our US-based products, it's only accredited investor capital that's coming in. And so we sit at this unique juncture where we're making the best of DeFi capabilities and blockchain technology, but also ensuring that there is compliance and permissioning that is going to be required, not just for institutional counterparties that we have today, but as we think about the expansion of institutional capital coming more and more on chain into the future, it's not like that AML and other responsibilities are going to be absolved just because we have legislation and real progress within the crypto ecosystem.
Yeah, I mean that's a big one for sure. So now let's talk about a little bit about the credit risk, right? So how would you define the credit risk in the context of, like, crypto native institutional borrowers?
So we think about credit risk in our secured lending products, which is the majority of our business, in two main ways. One is the quality of the collateral that's being posted, and that's obviously a big one. And then the second is the counterparty that you're taking exposure to. And so we, on the collateral side, we do a very in-depth analysis, right? And we're on what liquidation scenarios would look like. And so we're able to take a lot of moments in history, right? When there's these big sell-off days and big sell-off periods, we're able to take those scenarios and then put them through our kind of risk engines to say, all right, in these scenarios. So that's on the collateral side. So we're gaming out these scenarios, ensuring that we have significant buffer and understanding of what's required in a liquidation scenario for these collateral assets, and then ensuring that we have multiple venues where we can be liquidating these assets. And so that's where we're really well set up with an automated system that is managing collateral in real time, monitoring collateral, liquidating collateral when required and when margin calls haven't been met. To date, for our secured lending product, we've only ever had one partial liquidation, and we've never had any losses. Then on the counterparty exposure, the unique benefit of Maple is that we aren't just taking the benefits of the security over the collateral, but we have direct recourse to the borrower's balance sheet, right? So the borrowers are taking on recourse loans. And so in the event that the collateral liquidations don't cover a loan, which has never happened to date, we then still have recourse to the underlying borrower. And so that's a really important aspect of our counterparty exposure. And then part of our counterparty assessment, right, is that we're going through and understanding their balance sheet, understanding their ability to be topping up in the event of margin calls, because we don't ever want to be in the position where we're liquidating, right? That's not a good scenario for our borrowers. It's a terrible scenario for our lenders. So we want to ensure that we're managing risk to avoid that. And so that's why we're only facing off against larger counterparties that have the ability to really support significant margin top-ups, and that they have significant equity buffers within their balance sheets.
That's actually interesting, and let's go deeper into this, because that means in a traditional world you need to underwrite this risk, right? So you have a framework, I'm sure. So maybe you can share with us, what does your underwriting process look like for assessing borrowers' credit worthiness?
Yes. So if we take an example of a new borrower coming to Maple for the first time, so that borrower will come to us, or we'll reach out to them, and then they will begin the onboarding process. And so that onboarding process is a pack of information. And so part of it is their KYC and understanding compliance requirements. And then the other part is an initial assessment of them as a counterparty. And this includes financials, understanding their operations, right? So we're performing operational due diligence, because just as much as it's important that they have the assets, it's equally important that they have 24/7 operating team that's able to, in the event of a 3 a.m. market sell-off, that they're able to be online and operate. And so we're thinking about all of the different elements of risk, not just financial risk when you think about facing off against a counterparty. So that pack of information is filled out. Then the onboarding goes through. Then we look at the assets that they want to borrow against. And then we will take that to our investment committee, right? So a new borrower comes on. The process is that it then comes to an investment committee decision to onboard that borrower. Once all of that process is done, then an initial loan will be struck and deals will be agreed on. And then we will scale that borrower through time. So we're never like out of the gates doing $100 million loan to a new counterparty, but we're building the relationship. We're starting to understand their operations. We're starting to, and they're also doing the same for us. And then the relationship expands through time. And that's one of the things that needs to be ensured. Whilst we operate in crypto in a trustless way because of blockchain technology, that doesn't mean that trust is eliminated, right? Relationships are still very important, and we place a real emphasis on not just how we arrange the initial deal, and onboard that counterparty, but then manage that relationship through time.
Yeah, that makes total sense. One thing I would be curious also to find out, and I'm sure the listeners would love to know it too. How do you evaluate off-chain data? Like you mentioned, you look at the financial statements, probably you look at tax records or business history for borrowers, right? So basically they have to open their books fully, right?
Yes, and it's still something that's so they do have to open their books fully, and if they're not willing to provide this information, then it's then they won't get onboarded. And so it is a hard requirement that they provide this information. Um, and maintaining that discipline is very important. And so it's because it's always easy for
Hmm.
your risk requirements to deteriorate through time, and you get excited about a new borrower and their potential and all of that kind of stuff, and then it deteriorates. And so that's why there is this important separation between the originations team and the investment committee. So, I'm never really I sit on the investment committee, but I'm never involved in the day-to-day of onboarding a new borrower. And so we're trying to maintain that independence in the way that it's structured in the pipeline coming up to investment committee that meets every week. And so it is structured like a more traditional risk manager, right? Or any asset manager that you expect in traditional finance, where there is this oversight body that is responsible for managing risk overall.
And is there a standardized credit scoring model used across the platform, or is it like pool specific?
So there's no standardized crediting model. So we're not like generating a score on a borrower or anything like
Hmm.
that. But it is going through a defined framework. But there's no score that gets spat out at the end as a result of that framework. And credit scoring is really a more retail thing, I would say overall. There's been a lot of attempts in crypto to try and bring in crypto score, credit scoring, and you can rate this address or rate that address and all of this kind of stuff. It's still very nascent. I think it will get there. But for us, when we're facing off against institutional counterparties, it's a little bit more of a less rigid process in terms of just like these three inputs give you this score, right? There is more nuance to institutional counterparties. And that's why we kind of manage it as both a quantitative and qualitative risk assessment.
And do you utilize like traditional metrics such as like debt to equity ratio, interest coverage, or cash flow analysis?
All of that is plugged in when assessing the financials of any counterparty, as well as then understanding the makeup of their balance sheet. Because these are all crypto institutions. They're holding a large portion of their balance sheets in crypto assets. And so you can take a snapshot of their balance sheet at this point in time, and then as there's a market sell-off, they're so fundamentally long the market in some cases that you need to really understand that. And so the makeup of their balance sheet and how they're generating revenues, how they think about diversifying their balance sheet into dollars and stable coins out of just risk assets is really part of that assessment. And so you want to understand the counterparty in a lot more detail and understand their business. And that's where we've really built up a network of borrowers over the course of 5 years, where we have long relationships, we understand their businesses, and that they enjoy borrowing from Maple just as much as we enjoy lending to them because we've developed these relationships and understandings.
And do you mind disclosing how many borrowers you have in total?
So currently, off the top of my head, it's about 29 institutional borrowers
Mhm.
that are onboarded, and it will vary through time and depending on market conditions on how many of those are being lent to at any one time. But it would be always around 50% of our onboarded borrowers would be being lent to. So there's a decent amount of diversification. But diversification for diversification's sake is a tricky catch-all that you want to be managing, right? And so you could, if you think about counterparty exposure, you can go and onboard the next 70 counterparties. But if you wanted to do that, you're going to at some point be deteriorating the quality of that institutional counterpart. And so there's a real balance there in how many you onboard, how you think about what's the next incremental borrower to onboard versus issuing a loan to one of the existing
Mhm.
counterparties that you know to be strong and already have a relationship with.
Yeah.
So the pipeline of our borrowers is something we think about a lot.
So it's like in your case, it's almost like less is more principle, right? Sometimes this quality of an existing customer that can increase capacity is easier to scale up than to onboard a new one, right?
Yes,
And then
exactly.
to monitor continuously, right? Um, One thing like would be curious probably for the people who are not familiar with institutional lending practices, right? What type of like without naming like the firms, what type of borrowers do you have?
Mm. So if you think about the major types of institutions that exist in crypto today, they're really all around financial services, right? And so you have exchanges, trading firms, OTC desks, market makers, and then different types of funds, typically more hedge and liquid token funds that will take longer positions on the market. But those are predominantly the counterparties. We then have a smattering of high net worth individuals that are in there. And these are like ultra high net worth individuals that will be, they typically take out like very low LTV loans and are just kind of looking to access a bit of longer term capital from there because they were very early in ETH or Bitcoin or whatever it may be. But that's the current makeup of the book. And then depending on market conditions will depend how much is like going to a prime broker versus to a high net worth versus to a long only fund. So it's always interesting in the dynamics of the markets. But as an example, like when the basis trade is on and things are ripping, then you've got more of your book going to the prime brokers. Whereas in a profile like we're in today, where yields are much further down, then it's kind of your long only funds and your high net worths that have more demand for capital. So it's important to have that diversification of profile so we can manage our yield outperformance in multiple different market dynamics.
So the yield that you disclose publicly on your website is technically an average yield because from different for different clients it can also vary.
I would caveat that it's not an average. It is the actual yield that is generated from the underlying loans.
Got it.
And so it's an important aspect is that because we're running everything through smart contracts for our lending infrastructure, is that the diversified set of loans that come out of any pool then pass that yield directly through to the lenders. This is one of like the big benefits of Maple from an operational standpoint. There's no back office that's there like calculating the yields and how much did I earn today, how much do I earn tomorrow. Everything is automated, all of the accounting is automated, all of the yield pass through, all of the interest payments, everything is automated through the smart contracts. And so that enables us to provide real yield calculations, real transparency on the collateral, real transparency on everything that's important from a loan and lending perspective to those allocating capital. And we really see that it's like an important fundamental of our business is that we wanted to transform the opaqueness of institutional credit and make it something that people are able to leverage the benefits of blockchain technology to have those real-time insights for where their capital is being allocated, how their capital is being allocated.
Yeah, which is impressive, and we'll get a little bit later into the benefits, the actual benefits of DeFi over the traditional. But I first need to talk about risk, which is less sexy topic, but we need to answer those questions because I get them a lot.
Sure.
So another questions which I was asked, like what forms of collateral, if any, are typically required? Like you mentioned, obviously liquid digital assets, right? But do you even manage under collateralized or unsecured? Like, do you go into unsecured lending by any chance?
We don't do any unsecured lending. So
Okay.
everything that we do is over collateralized. Everything that we do is over collateralized by liquid digital assets. And so we have different yield products or lending products that are available to allocators. And these are set up to manage your risk return preference. So as an example, on our two main secured lending products are blue chip and high yield. Blue chip is ETH and BTC backed loans only held in third party custody and nothing happening or any yield generation on that collateral. right? So much more vanilla, simple, risk-off product offering. And in this market, it will, overall, it will range somewhere between 7 and 11%, depending on market dynamics. Then you have our high yield secured lending, where we take a broader range of assets as collateral. So this will include Solana and XRP. So we're not going like way down the risk spectrum, but slightly less liquid, but still very liquid digital assets, but are more volatile and subject to more risk. We take those assets into our custody with the high yield product, and then we'll generate a yield on them. So in the case of Solana, we'll take that Solana in and we'll stake that Solana. And so you get this combination of the yield profile of the underlying loans plus the yield that we generate on top of the collateral makes up the combination of the yield for the high yield product. And so that will average anywhere between 11 and 16%, again, depending on market dynamics.
Which is impressive and still higher than any other like traditional, like I would say, equivalent.
Absolutely. And you're still talking here very over collateralized loans. We're operating at LTV levels or over collateralization ratio. So over collateralization ratio, 165% plus on average, and liquidation, or LTV levels that compared to that, 60 to 70%, right? So these are very well protected positions, and that have significant buffers in them for when margin calls are made and where those liquidation levels are.
Yeah. So just again, basic question. Is there a way to lose collateral?
Is there a way to lose?
Is there an option? Is it even an option? That's what people ask us. Is like I'm telling that it's not possible, right? But I want to hear it from you.
Yes. From my perspective, it's highly improbable, right? What needs to happen is in order for there to be any loss is that the assets that we take as collateral need to go through levels, and there needs to be a sell-off that's been unprecedented, right? And then when we face off against the counterparty, there needs to be no clawback from there. So the amount of protection that we have is extremely substantial and is spoken to in our history, right? As I said to you before, we've done billions of dollars of this lending. We've only ever had one partial liquidation. We have an average margin call cure time of 3 hours, and we've never had any losses to any lender at any point in time. And that's over the course of 18 plus months. And you can think about like the level of volatility and the sell-offs we've had during that period of time. Think back to like August 4th last year, Bitcoin hit below 50,000, right? And at no point have we ever had any hesitancy that we were not going to protect lending capital. And I sleep well at night knowing the level of automation that we have around our collateral management. And that if anything happens whilst I'm sleeping, I know my monitoring system will wake me up.
Which is impressive, right? And by the way, this was one of my next questions. How does Maple handle the concentration risk, both in terms of borrower exposure and sectoral or maybe geographical risk?
Geographical is not something we're too concerned about. Crypto is kind of like a global industry, whether we think about geography more from a compliance perspective than we would from any other sort of financial risk perspective. Then we definitely look at our exposure from a collateral and counterparty point. Now, in terms of collateral, the majority of our books are always BTC backed, and then it kind of goes down the risk spectrum from there. So you're kind of like it moves depending on the markets, but more than half of our assets would be Bitcoin backed. The liquidity and profile of Bitcoin is like incredible. So when we're a long way away from Maple being big enough to be holding enough Bitcoin to be worried about the liquidity concentration of Bitcoin. But then when we think about any more assets that are further down the risk spectrum and less liquidity, then we are always managing in real time what that profile of our holding versus the daily liquidity and other risk metrics that we monitor, what that ratio looks like.
But
Then
by computing, quick, like interesting, like also caveat here, like by computing, like some of the risk profiles, do you even know the number of where the concentration should go to a degree, I don't know, 100 billion, where it's already going to be challenging for you to manage?
the amount of Bitcoin, well, I mean, yeah, 100 billion would be that would be getting close. Like if you look at like what's daily volumes on Bitcoin, you're looking at 30 billion in the last 24 hours, and volumes are down a lot at the moment. So like that would be reasonable, right? If we were ever holding that amount of Bitcoin, but that shows you the amount of capacity there is for Bitcoin backed lending, right?
Mhm.
We are still so early in the, and we'll get into this later, I'm sure, in the maturation of an institutional financial market around crypto assets and around Bitcoin. And the fact that Maple is one of the largest asset managers in the space at only at 800 million just shows you how much further we have to go and how early we really are.
Yeah. Your traditional counterparties are in tens of billions, right? So,
Yeah.
so yeah, definitely a long way to go. Is it relevant to talk about the loan covenants and like how are they enforced? Are you practicing them?
Yeah, so loan covenants. So I mean, it's important to call out that every borrower signs up to a master lending agreement. Then there is a term sheet that is a series to that master lending agreement. So for every loan that gets taken out, it sits under that master lending agreement. That master lending agreement is reasonably standard in institutional finance. So it has all of the typical clauses that you would expect around disclosures and what other breaches of a loan would be that are more qualitative in nature. Um, and then within the term sheet of every loan, everything is spelled out. The collateralization levels, the margin call levels, the liquidation levels. So all of those details that then service up into the master lending agreement are always outlined clearly. And then importantly, are memorialized on chain. So then there's the execution of the term sheet that sits under the master lending agreement. And then in the smart contracts, the loan is initiated on chain, mirroring those terms. And so then it's transparently available for anyone to come in and see what the terms of that loan is. Now they won't know the name of the counterparty, but they will know every other aspect of that loan. And so that really is an important feature, is that you can go, and when I say how and where your capital is being allocated, I really mean it. Like this is where you have that level of transparency that is unparalleled in terms of understanding the risk management of the loan. So it's not just us saying what we're doing, it's us showing you and you being able to trust and verify.
Mhm. And having said that, like, I'm sure there are other like aspects, like if you're talking about risk management, like right now we're in a global macroeconomic, I would say, shock in a way, right? And so do you have a contingency plans for macroeconomic stress scenarios or maybe interest rate shocks?
So yeah, I mean, Trump keeps things interesting, that's for sure. So
Not boring.
that's right. So we definitely think about the macro environment. We think about what it means for risk assets and what it means for yields overall. So we think about it in terms of volatility for the markets and what that will mean for our collateral that's backing these loans. Um, and then we also think about it in terms of raising capital, because actually in these types of market environments that this is the 31st of March, is where yields are off, there's a lot of hesitancy going into tariff Wednesday or whatever it's going to be, and so, but this is actually where we do better, because we accumulate a lot of capital in these kind of sideways choppy markets when there's a lot of hesitancy, because people trust Maple to be able to outperform other yields and to adequately manage risk. And so we actually see it as a big inflows. And so we think about it, how we capitalizing on these markets to prove our value to allocators, and show that continued and consistent outperformance, no matter what the market conditions are.
And in terms of monitoring this risk, so you mentioned you have like some proprietary systems in place. So what ongoing monetary systems do you use to track the borrower health post loan origination, and how often do you do it?
Mm. So we are managing everything in real time. And so maybe to take a step back is that half of the Maple team is capital markets and operations. The other half of the team is engineering and product. And so we are a technology business at our core. And so we have built everything in-house in terms of the way that our smart contracts operate. That's all proprietary software deployed on the Ethereum blockchain. And then how we manage our collateral. And so we have everything being managed in real time. We're getting price feeds from multiple sources, so we're never reliant just on Coinbase as a price feed. We're managing it across multiple price sources, and then it's constantly being monitored. And so the entire loan book is verified and sits on chain, and so then comes into our database. And then we know where all of these margin thresholds are for each of the assets that we hold as collateral. And so every second, whilst we're sitting on this call, it's checking, right? And as soon as there's a breach, so if there's a big wick down and then it hits a margin call level, then the warning will go off, right? And so, and then if it hits that level, then messages are sent out directly to the borrower, informing them that they have a margin call to meet, and the clock starts. That clock then runs for 12 or 24 hours, depending on the counterparty, for them to then top up that margin call. And so this is where we have extremely well built out systems in order to manage that and ensure that everything's automated, right? You don't want guys clicking buttons or sending out emails or any of this stuff, right? Everything needs to be automated. Everything needs to be straight through to the borrowers. And then then the clock is started, and so we know exactly at what point in time the margin call is off if it hasn't been serviced, and then the liquidations will go through. So it's a pretty rigid process, right? We're not in the business of offering too much discretion. We're offering the right amount of flexibility to our institutional borrowers without ever compromising or having the level of discretion, because as soon as discretion comes in risk management is when you start to get breaches of your risk management processes and when you start to lose money.
Yeah. No, that sounds brilliant. So, but can we, again, without naming the company, of course, like, you mentioned that you had a partial liquidation use case. If you don't mind explaining how did that happen and how did the monitoring system identify it? I think that would be like very good for the listeners to understand.
Sure. So this partial liquidation happened on August 4th of last year. So I mentioned it before. It was a big sell-off day or period, and Bitcoin went all the way down to, I think it touched 49,000. And so what happened during that time is that Bitcoin was selling off extremely quickly, and so we hit the margin call level for this borrower. Bitcoin then kept going through that level, and they hadn't responded to the margin call, but we have drop dead liquidation levels. So there's an extra level of buffer that exists. So let's use an example: 60% initial LTV, 70% margin call, 85% liquidation level. So they hit that 70% level, then Bitcoin keeps selling off, hits 85%, bang, we sell. There's no messing around. I'm sorry, you didn't respond to the margin call. Bitcoin has continued to sell off, and it's hit this drop dead liquidation level. You're going to get liquidated at that level, and because that extra buffer between 85 and 100% is the liquidation premium buffer that we have to protect lending capital. And so that's what happened during that scenario.
And just to clarify, like, so that happened the same day, I assume, right?
Yes, same day. Like we're talking within 2 hours, it hit the margin call and then hit the liquidation level.
So let's imagine for whatever reason the client is unhappy and they think like, oh, we were not watching our computer, we didn't get the message, we didn't get the phone call. What legal recourse do they have to, let's say, go against and say, hey, like we were unfairly treated?
Uh, Well, to be transparent, is this borrower doesn't borrow from us anymore. They were extremely upset with us,
Mhm.
and they threatened legal action, and they don't have any leg to stand on. They are signed up to this master lending agreement. It
Mhm.
clearly outlines all of our rights. These are legal agreements that are put together by the top law firms in New York. There's no messing about, right? This is institutional lending. This is the game we play. These are the terms you signed up for, and we're not compromising on protecting our lenders' money.
Perfect. So there is no kind of way for you to almost lose money in this scenario because it's the reaction, the monitoring system is so intact. The reaction is like seamless within like minutes and hours, right? So you can liquidate, so you keep your risk management like I would say impeccable and to a degree that like it doesn't have an opinion. It's algorithmic, right? So like again, it's nothing personal. So you would I assume you would potentially, if they would love to, you would be willing to work with them further, right? But because they didn't like the process, like which they signed up for, it doesn't happen, right?
Yes, yes, yeah,
Yeah.
and it's an important thing and something we're very transparent with our borrowers about. Is that like these are the terms we give you we give you the flexibility, right? You have this margin call level, then have this level of tolerance and this amount of time to service that margin call. But once it hits that liquidation level, or once that time period is up on the margin call, our hands are tied.
Yeah.
And so we're not a smart contract like Aave that's going to automatically liquidate you, but we're also not this like broad discretionary lender that just is going to, it's not like 1970s banking. You just call up your bank and say, give me another 30 days, right? We need that level of rigidity, and we say that we're striking the right balance. We're providing white glove institutional experience to the borrowers whilst maintaining the level of 24/7 monitoring and automation that's required to manage the book properly.
So that might happen even over weekends, correct? And you will still react automatically. You have places like and processes like to make sure you kind of respect the risk management system, right?
Yes, yes. Unfortunately, normally it happens at the Asian market open on a Monday, right? And so normally it's like Sunday night my time, is when and that like August 4th was a Sunday. Yeah, if you look at the typical volatility, it's normally Asian market open on a Monday.
So I mean, you mentioned in 18 months, so only one, I would say, it's not a default, but partial liquidation, so to speak, right?
Yes.
So no other distress loans, no other liquidations whatsoever.
Only one partial liquidation, and so in that event, yes, definitely not like it's nowhere near to a default, right? Like it's just that
Hmm.
the asset that is securing the loan had to be liquidated in part in order to protect the value of that loan. And so and in that circumstance, we liquidated 30% of the collateral value, right? So it's like we also have like a calculator to predetermine how much we're going to liquidate of the collateral to bring
Hmm.
it back to a healthy level. And so we liquidated 30% in this instance, and then it gets brought back to a healthy level. The borrower then repaid the remainder of it, and the loan was done. And that's been the only partial liquidation that we've had to perform. Everything else has been, we've issued hundreds of margin calls, and we have an average service time of 3 hours for the time that the margin call gets issued to the time that the collateral comes in to top up that margin.
That is impressive, in my opinion. But now, for someone who is not coming from traditional lending background, so now I
Mm.
think the time to focus on also the positive aspects of like, the comparison with traditional, I would say, like counterparties, right? So, um, like let's talk about like in what ways do you believe your credit risk management is superior, or I would say more transparent than any traditional lender?
Mm. So, if you think about the world of equity margin lending as probably like the easiest comp for traditional finance, is that you get a couple of things that with crypto and digital assets that you can't get in the traditional world. One is that these assets trade 24/7. So you're getting kind of unprecedented liquidity profile of these collateral assets, and therefore the types of lending that you're able to do against it. The second is that there's full transparency. And so you're able to lend through Maple with knowing exactly all of the underlying loans. But then we provide the addresses for you to go and say, all right, well, here's the Bitcoin that's backing that loan. And so that's like one of the real things of blockchain is this level of transparency. You don't necessarily need to know who that counterparty is, but you can know that there is Bitcoin sitting at the address that's backing this loan. And so that is, and I will just continue to repeat it, is the reason we started Maple in the first place was to bring this efficiency and transparency to an opaque marketplace that really existed only for the elite and those that understood that were extremely financially literate or deep in within financial markets. And so we are big about exposing and expanding access to these types of yield profiles, and leveraging kind of the three main attributes of blockchain: efficiency, transparency, and accessibility is the final.
Mhm. Yeah, I mean, I think it's impressive, like, how far the DeFi went and what you're building. And just for the perspective, I was reading like re research papers before the preparation of our interview, right? I like the global lending market right now, like, we're talking about like, just maybe that what, $10 trillion, where the consumer lending is like huge. It's $27 trillion. The bond market is
Mm.
what, 119 trillion, right? Private credit is about, 2 to 3 trillion, right? And I don't know, do you know the number? What is the total DeFi lending market cap right now?
Total DeFi lending market cap may be in the order of 30 to 40 billion.
Exactly. So if we compare it just like to private credit markets, like it's already like, way smaller, right? So it's like a drop in the ocean. So here comes the question to you, Joe. Like, what do you think are the biggest challenges as of now, right? And what do you think needs to happen so that eventually we become at least 1/10 of the global market?
Yes. Wouldn't that be exciting? So, I think there's a couple of things there. One is that the debt is what runs the world, right? And so if you think about the expansion of humanity and accelerating human growth and potential, debt is what facilitates that and accelerates that. Everything that exists around us, every bit of infrastructure, is only possible because of debt. And so it has this real negative connotation to it. Everyone thinks, oh, debt's a terrible thing. Debt's an amazing thing, and it just needs to be understood better. But what does it look like for DeFi to expand and for DeFi lending to expand? It requires two real things. Everyone talks about the tokenization of real world assets, and that is going to happen through time. And there's many people that are working on that problem, but tokenizing an asset does not actually add any utility. It only unlocks the potential when that asset is available as collateral. Everyone lives in this dream world that tokenizing a real world asset, if I put my house and tokenize it, that all of a sudden that house is going to trade every day, right? It's going, someone owns it tomorrow that was different from the day before. Right? That's not going to happen. What's going to happen is you're going to unlock liquidity by these assets being available as collateral to borrow against. That's going to be the unlock of liquidity. And so when you think about being able to bring more and more assets on chain and then unlock their utility and their value by tokenizing and collateralizing them, that's the unlock. The second major element is that institutional capital has to flow on chain. And that's really where the gap is, right? We have a severe lack of dollars in the system. Stable coins today are maybe 250 billion total or
Yeah.
something like that. That needs to expand multiples, orders of magnitude larger, and that only comes from institutional capital being able to come on chain. And there's many things that block that today: infrastructure, understanding, having to pay this crypto risk premium because people don't understand crypto markets, etc. But over the course of the last 3 months, we're starting to see that narrative shift, and a lot more institutional counterparties will be able to come into the space and be unlocked by things like new legislation.
Yeah, I'm very excited about it because we've seen a lot of examples of this done through tokens, through NFTs, and as you mentioned, right? A lot of them are like, at least in the United States, there will be a security, right? So not a utility. However, there is case to be made that a lot of real estate, let's say in Dubai or many other places in the world, they are there are frameworks to still kind of trade them as utility tokens, as you mentioned. You borrowing against an asset, which is highly risky endeavor, but people are already experimenting this. And big institutional credits, hedge funds are also being tokenized. So we see more and more, I would say, examples of programmable credit risk, transparent yield tracking, and I do believe that tokenization is just inevitable, like trend for anyone, right? So and we can talk about this like forever, but like one of the few questions, like at the end, I want to ask you also is like, in terms of, you mentioned regulatory and framework, right? So what needs to happen, and with this current administration, what are the pivotal frameworks they need to accept so that the DeFi will become sexy again?
Mm, mm, mm. Yeah, I'm not sure why or how DeFi lost its sexiness, but we need to bring it back. So I think it goes to the point before. I think the biggest first unlock, and we're seeing real progress on this in real time, is the stablecoin
Mhm.
legislation. And so that is going to really enable institutions within the US to be able to come and participate more broadly in crypto markets. Like it or not, US capital markets make up more than 50% of global capital markets. US is where it needs to happen if there's going to be mass amounts of institutional capital come into the space, and stablecoins is really the start to that. We then saw a few other things like SAB 121 and unlocks like that from an accounting perspective and tax perspectives that enable counterparties to hold crypto assets on their balance sheet. But I would say it's very good, the progress that we're making on the stablecoin legislation, and that should be the first big unlock when we can
Mhm.
really, it's the first major form of tokenization, right? We're tokenizing the dollar, and then and then you can see the expanse of utility that then is built on top of that, how it impacts payments and trading and so many other things, right? And so that's why it needs to be the first thing that's focused on, is expanding the amount of dollars that exist in the crypto ecosystem.
Mhm.
Then from there, once you have those dollars, then you can focus on building out more and more utility, and more use cases will be able to be facilitated because just a larger portion of global capital markets exists within the crypto ecosystem.
Yeah. I mean, we just received the news today that Circle is going public. Uh,
Mm,
so that's actually very good news because they have to be held by higher standards of scrutiny, like on all levels, auditing all their books, financials. For anyone who never saw how that happens, that means they already probably did their homework 1.5 years ago, right? Um,
yes.
Now, USDT Tether, which is the biggest now stablecoin issuer in the world, it has its own systematic risks. And a lot of people tell me, well, their books are not audited. How are you sure that at some point they're not going to be depacked and there's not going to be like systemic, risk? What would you reply to this?
So I think there's been a lot of FUD generated around Tether overall.
Yeah.
And that in the that even if you listen to public statements by their CEO Paolo more recently, he's very open to, and they're actively looking for a Big Four auditing firm to to perform an audit on. It's been that these accounting firms have been actually restricted and prevented from auditing and engaging in any sort of crypto activity because of previous administrations and their own risk parameters going, well, we don't want to touch or risk assess crypto. We don't want to be exposed to that. They see what happened to an accounting firm that touched FTX and they're like, we don't want to be part of that. So I would say it's that Tether, yes, could be more transparent. I think they're going to be into the future. I think when you see the likes of the counterparties that are holding their treasury assets, like Cantor Fitzgerald, and the amount of profitability that Tether is producing and has produced, I think that they've maybe been unfairly subjected. And if you go to Asia, Tether is a god there, right? Like it is the asset, it is the stable coin, and you don't hear any of the FUD that you hear in US or Western capital markets. And so I think there is this kind of polar opposites, right? You've got Tether, which is the predominant stablecoin in the East and in Asia. You've got USDC, which is the more predominant asset here in the US. I think that with the new stablecoin legislation, the two will converge, and it will be a market of two major stablecoins, and then we'll see how it transpires further from there.
Yeah, that's I like this perspective. So
Yeah.
let's hope it
And
happens.
I think it's important also that there's so much new stablecoin projects out there,
Mhm.
right? And yeah, I like admire all of these founders, and I think like innovation is great. But if we're thinking about it purely from an institutional perspective, I think fragmenting liquidity across tens and hundreds of different stablecoins is going to be a real blocker for institutional counterparties. I can understand that PayPal wants their own stablecoin to operate within their ecosystem, and Revolut will probably want the same. And there's reasons that you do that stuff. But from an institutional counterparty perspective, I think it makes it much simpler, and it should be about reducing the number of hurdles that sophisticated allocators have to jump through or jump over in order to get their capital on chain. And so aggregating around a few major, or in this case, two major stablecoin issuers, I think would be beneficial for the space in terms of scaling.
Yeah. I do believe that overall, with account abstraction, if it's done right, like some people who are going to get into some other stable coins, I'm a big believer that there's going to be a huge trend of commodity-based stable coins. For example, we're talking to one of the issuer that is pegging their stable coin one-to-one to gold, which is also, if you think about it, gold right now has a better reputation than dollar, right? Look at what happens with the pricing. People in distress always go to gold, like because that's their safe harbor in their mindset.
Mhm.
So if we do the right thing, like a regular user would not even care. So the like basically the swapping of one stablecoin to another will be so seamless and it's going to happen under like at 1 second that wouldn't care. But that requires a lot of alignment, as you mentioned, right? So,
Yes, yes, yes. And it still means that you still need this aggregated layer of liquidity, right? That's the most important thing,
yeah.
is that you see with the infrastructure across crypto at the moment is that we're fragmenting it across different assets, different blockchains, and it's not conducive to one ecosystem being built cohesively to enable success for everyone. And so I think all of this cross-chain stuff and stuff that's kind of like trying to pull it all back together, right? Because we got too fragmented is required. And then hopefully, in the same way that if you think about the success of the internet, everyone conformed around TCP/IP, right? It needs if we want to get to real scale, it needs that same level of conformity. Now, that doesn't mean that we need like everyone to only be on Ethereum. But it at least needs us to agree that this is where we all operate within, and then liquidity is able to aggregate and markets are able to aggregate around that. rather than everything being fractionalized and fragmented.
Yeah, 100%. I agree. I think that's definitely the path for the future. Now, there's one last question, which is I typically never notify my guests about it. That's why it's going to be fun for you as well. It's a
Okay.
personal question. So,
Okay.
Joe, what is the meaning of life to you?
The meaning of life. Okay. For me, the most important thing in life is love, and that has been really the major revelation for me, or the major purpose driver was meeting my partner, and so she's brought a whole different dynamic and purpose to my life. I would say if you met me 5 years ago, Maple was the be all and end all, and now I have a much better, more holistic, um, and value driven perspective on life. And that has only made me a better founder, leader, and and manager of Maple. And so I think that hopefully I maintain that perspective that in the end we're only here for a short time, and if we're not having some fun and loving the people around us, then what's it all for?
Love it. That's beautiful, and I can tell that it's coming from the heart because yeah, it's definitely like I never notify people, so I love this.
Yes, yes, I didn't know that question was coming. I can verify that.
That's why it's the best. Like, um, beautiful. I really appreciate your perspective, John. I know that like, you're gonna be successful. That's why I was excited that the TDX is the first integration with Maple, right? We did with you because I do believe like what you've built is very secure, and we also did a lot of research before, doing this. So yeah, I wish us all success in the world to reach billions of in TVL, right? And then eventually, by that, help others to get into amazing opportunities to use, if you think about it, even USDT or USDCs that are idle, that are sitting on your MetaMask or Trust wallet sometimes and you're not doing anything, you might as well just, use the compounding power of lending and then just have like 9 to 11% yield. Like, and the way I explain it to the people, like it's still much better than a bank. The bank would give you maybe in most of the countries 1 to 4% tops, if that. Right. So I think that's powerful. The fact that it can, the user can go in and out, right? They're not like, they're not locked for 12 months or 18 months, right? So that's also a huge benefit, right? It's 24/7, it's secure, it's programmable. So that's why it's my passion is to bring this wealth to others as well. And I know you do have the same vision, and that's why it's very exciting. Thank you so much, Joe.
Thank you so much for the conversation, the partnership, and look forward to the future together.
Thank you.